Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. I have two awesome guests in the studio with me today. I guess one is a guest, Tony. You're not necessarily a guest because you're always with me. You're my man. You're my co-host. You're the reason I'm on the air. You're the one that keeps me on the air.
Oh,
But
I don't
then
know
we
about
have
that.
an awesome guest sitting to your left. Those of my viewers are seeing it's on the right as you view. We have Tyler Ellegard, portfolio manager of Gradient Investments. Tyler, welcome back to the show, my man. How is everything?
Good. It's been a while.
It's
Took a little
been a
stint out of
spell, yeah. I mean,
yeah.
we're going to catch up with a little bit here in the first segment, as you probably remember from being a guest on my show many a times in the past. Our first segment here is a lot of times Tony and I catching up with what's been going on in our personal lives and, just kind of, what life in general, right? And then we really get into some what I'll call the meat, potatoes, or gory details of the show as we move into our second, third, and fourth segments. But in this segment, I also want to touch on, Tyler, what's been going on with Gradient Investments and with your career and with your family. I want to bring you right into the loop so all my listeners and all my viewers can really get to personally know Tyler Ellegard.
Yeah. So it's been a while since I've been on the show. Reason for that was I took another job with Gradient, a sister company called Gradient Advisors, being the president of that company for a little bit. Got the ship turned around a little bit. So they asked me to come back to Gradient Investments. So I happily obliged. So now just back to managing portfolios and, life at home is busy. I've got two kids, a 4-year-old and a 2.5-year-old, both boys.
Oof.
Good example is this morning, they were up at 5:30 in the morning and they just start beating on each other. So we're already there.
For no reason at all. Just started beating on each other.
And then all of a sudden one starts crying at about 6:15, and that's when you kind of got to go and break it up.
Yep.
So that's my life is work.
Well, they had a good half hour, 45-minute run though.
Yeah, that's because I didn't want to get out of bed.
Sounds like they take after you, Tyler.
Yeah,
That's
Some ruffians.
And, before we started recording, you mentioned that you guys went to the zoo yesterday. Now that was you, the wife, the boys. Tell us about that experience.
Yeah, it's I don't mind crowds, but when I have the kids and you're lugging stuff around and you have it's just not enjoyable. But the kids enjoyed it. They for whatever reason they love the bison at the Minnesota Zoo.
Oh yeah.
So we got
Buffalo.
to go see some bison. And then some of the tigers were out and actually moving around. So that was fun to see.
That's cool.
Those things are very scary.
But
yeah, it was not my favorite experience, but as long as the boys are happy, then I'm happy.
Yeah.
And it'll probably be a lot more of those experiences as well as you get to realize the things that you appreciate. But then again, when you have the kids, and Tyler learned, knowing from experience. So I have Lexi, who's turning 19 this month. I have Josie, who's turning 16 next month. And then Carson is turning 13 next month. So I'll have all teenagers. And
wow.
Since I've been through that 4 to 6-year-old, and Tony, it's been even longer for you, as we've talked about, because your kids are even a little bit older than mine, but we can kind of be the older gentleman and been there, done that, give the advice to Tyler that it doesn't get any better.
No, these are the salad days.
Yeah.
Actually, my favorite period is like from 4 to probably 10 or 11.
Yeah, so you're in the best of it right now, man.
Yeah, once the 4 to 11, they're so cute, they're so fun. You're their superhero. Those are the great years. You're going to look fondly on those years, and then they get into the teenage years.
Oh boy,
well, boys are so much easier than girls, wouldn't you say?
So far, so I
have 2 girls and a boy, and my experience was our boy was so much easier to raise. Girls, especially teenage girls, are the downfall right
and
there.
Carson's not the teenager yet, right? So he's only 12, he'll be 30, but
yeah,
when he has 2 older sisters that are teenagers, he kind of is already a teenager in some of the things, how he acts, things he does, right? But I could see myself, Tony, I could see myself probably looking back in about 5 years or more and saying, Tony Shore was absolutely correct. When we recorded that show, May 4th, 2026, he was absolutely correct when he said, but I think it's been great so far. I mean,
I love my girls, and I'm close to them both, but just when you look back after they're grown and gone, like we're empty nesters now. They all three, I got two off the payroll anyway. Our youngest daughter's still in the payroll, and maybe it's because the two younger ones in my case were girls, but
just the opposite for me than my youngest.
Especially like 13 on, between 13 and 21 for the girls, tough. We had, I think it's a lot harder, but that's just me. But kids are kids, and we got the one still on the payroll. The youngest one's had some struggles. What I like to say, 2 out of 3 ain't bad. No, I love all my kids. They're great. In fact, my youngest just graduated from Delta Flight Attendant Academy. My wife and I just we just flew back yesterday from Atlanta, Delta headquarters.
Yeah. Well, good for her.
Of intense training, 6 days a week, 10 hours a day. And then when you're not in physically there, they go back to the hotel where they put you up and you study, because you have to maintain a 90 percentile or above to make it through. 200,000 applicants, whittled down to 150 actually make it to training. And then in training, 70% make it through.
And so that's to be
she graduated. She is
an airline stewardess.
She is now a Delta flight attendant, and mom and dad get to fly anywhere Delta flies in the world for free. Standby.
Wow, good for her.
So we'll be traveling a lot. Yeah. I'll be sorry, Jason, can't do the show this week.
Why don't you fly out after the show? You're going to start taking your flights after the show, Tony.
Sure. Okay.
Well, good for you guys. That's exciting. That's very exciting.
Yeah. Not as exciting as now the kids. I know, Tyler, you have a couple of kids, but you're buying, you said you have to go out and buy your wife a vehicle today. And that's never fun.
No. Not looking forward to it.
Especially if it's a new vehicle. Wow. Cars have gotten so expensive, haven't they?
Mm-hmm. Yeah.
So for all my listeners out there, you're like, wait a minute. So Tony's talking to Tyler. Tyler's not really answering very much. So think about that. So Tyler has a 4-year-old and a 6-year-old, and the boys are getting bigger. They're hauling more stuff around. You were telling us at the zoo now you had a double side-by-side stroller. So that's all that much bigger. So you're upgrading your wife's vehicle, buying her a newer one, safer for the kids and the family, a little bit bigger. But yeah, I mean, the price of buying vehicles nowadays, and it's like, man, do we really have to bite this bullet and go through this torture? And it's a bittersweet. It's an unfortunate thing of, when you have the kids like that, you absolutely want to make sure they're in safe vehicles, them and your wife, and even you when you're in that vehicle, right? And so upgrading the vehicles. But yeah, think back, especially my viewers and listeners, you think back to maybe 5 years ago, 10 years ago, 15 years ago, 20 years ago. And we're going to chat more on the show today about the price of things, and that goes, even get right down to oil and fuel, and think about the price of automobiles, and what's going on in our stock market and our economy, that there's a lot of these things going on around the world that's supposedly hopefully being able to drive down the price of some of these things. And so we could talk about some of the things that have went down in price, which I think the only thing that's went down in price is flat screen TVs. Other than that, everything's going up. But
cars. I mean, especially Tyler, you being the senior portfolio manager and all, I mean, it's got to be hard to find a Maybach or a Bentley that's big enough to hold the stroller and the kids, right?
Right. Yeah, exactly.
I'm kidding.
That's exactly what I'm buying.
Didn't you say you joke, all joking aside, and Tyler, maybe someday you will have those luxury vehicles, but at this point, I think you said, what, a GMC Acadia?
Yep.
It's a good vehicle. I own one.
Really nice vehicle.
Yeah. I inherited, my dad had gotten one not long before he had to go into full-time care. So Sarah and I inherited that one, and we love it. I mean, it's been great, and it hauls a lot. You can fit a lot in there.
Yeah, which is what we need.
Yeah,
which is what you need, right? For the two boys.
Exactly what you need.
Yeah.
So before we jump into the markets, what's going on with the markets, what's going on with the various gradient portfolios, for our listeners out there, oil, what's happening with the global economic situation and here at home, let's take a moment to give away 10 copies of Jason's book called Empower Your Retirement. Right there you go. It's a great book. Listeners can get a copy. Just be one of the next 10 people to contact the office and say, hey, I heard about it on the radio, and he's holding it up for those watching the video on YouTube. Plan for the best, but prepare for the worst. Empower your retirement. Just call 989-835-7203. That's 989-835-7203. Or go to GreatLakesInvestmentAdvisors.com. Tell them you want a phone call back. They'll call you back, and you can say, send me a copy of that book. There's no charge, no postage, no obligation. And that book is such a useful tool. It's so helpful when it comes to your finances. And we'll be right back. You are listening to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, Jason Cryderman, and our very special guest, a huge get today for the show. We have Tyler Ellegard, Senior Portfolio Manager at Gradient Investments with us. And Jason, what are we talking to Tyler about? I'll let you ask the first question.
Well, I wish I could narrow it down to one thing we're going to talk to Tyler about. I'm sorry, Tyler.
Sure.
This show may be kind of what I'll call scatterbrained, right? So I really want to spend a lot of time, Tyler, picking your brain. Obviously, it's awesome to have you as a resource who's a portfolio manager, who's what I call in the trenches. So when I work with the families that I help build their income plan, build their management plan, whatever it might be, I tell them we're going to use portfolio managers, third-party portfolio managers, that this is all they do. They're in the trenches every single day. What I mean by that is they're basically on the floor of Wall Street. They're doing all of the research, all the trades, the buys, the sells, the what do we get into? What do we run away from? Why do we do it? How much do we do it? So really, truly roll up your sleeves and be in the trenches. And so Tyler, again, it's awesome when I can have you or another member of your team on as such an awesome resource on the show. Some of our shows are you're right, Tony, that, hey, we're going to talk about one topic and we stay on track. And it's really, I think with everything that's going on out there today in the United States, in the world, right? There is so much, excuse my French, but crap going on out there. And so we need to talk about something like what the heck's going on here in the US and globally. Why, what is the impact that it's having? What might change? What might not change? So Tyler, I want to ask you, from being in the trenches, from managing portfolios, as many as you have, as long as you have, and as good as you guys do, tell us today on the show, maybe the top 3 positive things that you guys see as portfolio managers in the trenches, then maybe the top 3 negative things going on right now, and then maybe we'll end the show with the top 3 lookouts for the future. And they could be good lookouts or bad things that you guys are really keeping an eye on. And again, for my viewers and listeners, this is coming from somebody who's managing billions and billions of dollars in the trenches for advisors and families all across the United States.
Yeah. So I think the biggest thing, the top things right now would be, or best things about the market right now would be the AI play, all of the infrastructure that's going in for AI and where we're going for the future of AI. That's really what has been driving the markets. And I would say we're probably in the first few innings of that build out and the actual use case of everything that AI has to give us. Yep. So I think that's number 1. Number 2 is we hear about oil and higher prices and how that affects a lot of the products that we use and affects the company's margins. But at the end of the day, AI also has created efficiencies for those businesses. And so you're still getting, so typically when we come into the year, we always look at what the earnings growth estimate is for the S&P 500, the aggregate S&P 500. What do we expect their earnings per share to grow at each year?
Sure.
The average is right around that 9-10% mark.
Okay.
We came into the year expecting 13%. Now, usually what happens is, who benefits from having 13% earnings growth? Well, Wall Street does, right? So typically what happens throughout the year is those earnings estimates start to come down more into that 8, 9, 10% range because companies are comfortable growing at that, right? You get some companies that might be growing at 3%, some that might be growing at 12, 13, right? And you kind of get that average of 13 or 10. Well, actually what's happened this year is it's actually gone up to 18%, even with the Iran-US war happening, which is a good backdrop for the market. And so that's number 2 is strong earnings growth. And that's coming from everywhere right now too. It's not just your technology names. Yes, the technology names are helping.
Kind of leading the pack, aren't they? Or they have been in the past.
They have been, yep. But now you're starting to see solid earnings growth in companies outside of tech, which we haven't really seen for quite a while. So that's a good thing. And then a third one would be, I would say interest rates are still low relative to history. So even though the Federal Reserve didn't cut last week, I would still say that's a good backdrop for the market. And then, I mean, I'll make what my thought is for the year, and I could be completely wrong. But last year, my thought was 3 interest rate cuts at the back half of the year. I think we'll get something similar, 2 to 3 interest rate cuts at the back half of this year, just like what the Fed did last year. And there's a whole host of things that go into that.
Sure.
Some things to look out for would be oil prices. Obviously, we've been watching that. It's not just this spike, and if oil goes back down to $60 to $80 a barrel, it's not that big of a deal.
Right.
Companies can offset that. It's a one-time thing. They're not going to push through prices to consumers. If we start to see this go on longer and longer and longer, that's where we have a bigger issue. Secondly, and it's tied to that, Tony's heard me talk about this in the past, is fertilizer prices.
Oof. Yeah.
So with the blockade right now, so urea is a base of the nitrogen fertilizer, and about 60% of exports come out of the Middle East. So that's a big deal when you start thinking about everything being blockaded. And now in the US, it's not as big of a deal because a lot of farmers plan for their growing season
ahead of time.
Whereas if you start to look elsewhere, a big one is Brazil. They're more on demand. And so all of a sudden the supply of their nitrogen fertilizer, they don't have it. So they might not plant. They might just let the crops die. Who knows what they decide to do. But either way, you're going to start to see the longer this goes on, the US-Iran war, the longer it goes on is inflation in food costs.
Right.
So now you're talking about 2 separate taxes on the consumer, which is not a good thing. So it's not as much about the US-Iran war, and they'll figure out their conflicts and they'll keep sending missiles at each other. And nobody likes war, or I should say I don't like war. I'm sure there's people out there that enjoy it, but I'm not a fan of it. But it's the derivative of the war that is more concerning in the impact that can have on the markets.
Yeah.
So that's where I'd be watching out.
Yeah, oil. Yeah, that affects everything. And like you said, if it's short term, it's no big deal. You know, if the war ends within a couple of weeks, or that gets straightened out, fine. But if it goes on for a few more months, you're gonna
start to feel it.
Yeah, and then I would say your prediction about interest rates coming down might not happen if that continues. If oil stays the same or goes up, the rest of the year, that could be a problem, right?
Yeah. And even for a while, the Federal Reserve, so there's expectations on what the Federal Reserve is going to do. You can look at each meeting on what the market expects them to do.
Sure.
And at one point, and you can look at US Treasuries, short-term Treasuries, you can see kind of where the market's expecting them to move interest rates to. And they're actually starting to price in a potential interest rate hike later this year, just because of elevated oil prices and then the derivative
the
impact
possibility of that,
leading to inflation.
Yeah.
So
because if oil prices stay high, it will start to affect inflation at some point, right?
Yep.
The cost of goods will rise because everything requires oil to be shipped. You know, boats, planes, trucks, the whole 9 yards, and farmers with fertilizer, and then oil-based products anything made out of plastic is oil based.
Correct.
So,
Yep. Pharmaceutical products.
Yeah. Wow. Yeah.
Right. So everything.
Yeah. But the markets, the surprise is, you mentioned this to me before the show. I didn't mean to hijack it, Jason, but I wanted to ask him.
Oh, this is great. I love it, Tony.
Because I want you to point out to our listeners, I'm like, what about my portfolio? What about the markets? People are seeing, oh, oil prices are rising and the global economy is being affected by this Iran war. So people get concerned, but the markets have remained amazingly resilient. We're still up for the year, right?
Yeah. So as of last Friday, so what's today's date? May 4th.
Yeah.
So as of May 1st,
May the 4th be with you. Star Wars Day. Yep.
The market was up about 6%.
Year to date.
S&P 500 year to date was up about 6%.
Yeah. And it's been so volatile. I think the volatility is what going up and down is what made people think, oh, the market's bad.
Yeah.
This year.
We were down at one point. We were down from the high. Now this is from the highs, not from the beginning of the year. I always look at from the highs.
Right.
At one point we were down, I believe it was 8.5% from the highs.
Sure.
And
because we've hit record highs. We've hit record highs.
Yeah.
Yeah.
And that's what people.
And it's important to point out, so when I sit down with all my families that I help manage their money for, and when we meet for their quarterly reviews or their semi-annual reviews, or when I have new people come in to see me and I tell them, hey, let me look at your current statements, because they talk about how bad my accounts are, how bad the market is. And I have to remind people that, yeah, you can remember when you got your statement that came in the first week of April, it didn't look very good at all, whether it was a quarterly statement for January, February, March, or it was your monthly statement for March. You felt bad. Why? Because as soon as you opened that, you saw losses. You were in the red. And so that made people think and feel, wow, the market's down. I'm losing all this money. Well, keep in mind, that is what I call very short term. That's limited vision, because that's only for that month or quarter. And yes, nobody wants to be down at all. That's not why we invest money, but it is the nature of the beast that the markets don't always go up. Sometimes they go up, sometimes they go down. So then when we keep it in reality of perspective, as you just mentioned, Tyler, if we look at year to date, where the market is, or if we look at the last 12 months where the market is, right? So we will see volatility. We'll see a chart or, a graph where the market goes up and down. But if we look back and take a more of a blinders off, larger picture view, market does go down. I mean, statistically, 73% of the time the market goes up, but that means 20-some to almost 30% of the time we're going to have downturns in the market, whether it be -1, -10, -20 to 30, which nobody wants to see, and it hurts short term. But I really think we got to keep that perspective again on the long term, as you mentioned, Tyler. People are thinking, gee, and Tony, you even started the conversation before recording. Hey, the market's down, and if we look at a short time frame like March, you're absolutely right. But if we open up a bigger time frame, like, hey, let's look year to date or over the last 6 or 12 months or so, we're still hitting all-time record highs. And I think that's important to point out. And Tyler, I get a lot of that from you guys when I look at your reports you send me every week, when I get the opportunity to talk to you guys every week and ask you these point-blank questions. What's going on in the trenches? Why are we seeing what we're seeing? What's the positives that come out of this? What are more of the negatives? How do you guys piece it all together, right? And I think you've done an absolutely phenomenal job at that. The track record on all the portfolios I've ever used from Gradient Investments has been absolutely phenomenal. Have they lost money? Absolutely, right? The market does. But overall, long term, they're up probably 70 or 80% of the time. So they might beat that average statistic. And so the numbers are just there. But I do think it's important that we point out that time frame, right? It's all in perspective. It's all relative. And so, that's important to point out.
Yeah. Well, hey, we need to take another quick break here. But before we do, I want to mention, Jason, that you are offering, along with the book, a no charge, no obligation consultation. If our listeners have questions about where they're at financially, or what this might mean to their retirement, when they can retire, how much they need, do they have enough saved? Are they allocated properly within the market, their 401ks, their IRAs? All they have to do is pick up the phone, 989-835-7203. Just call Jason and his team at Great Lakes. That's 989-835-7203. And you're listening to Your Financial Empower Hour. I'm your co-host, Tony Shore, here with our host, the man with the plan, Jason Cryderman, and our very special guest, the man himself, Tyler Ellegard, Senior Portfolio Manager over at Gradient Investments. And we're talking about what's going on with the markets, how we were talking about how resilient our markets are. And really, it comes down to not what's happening in Iran. A lot of it comes down to the company's overall performances. It's the companies, right?
Yeah. And look, oil is going to be a headwind for one company more so than another.
Sure.
So you just kind of have to understand that and figure out which ones have the most opportunity and which ones may be less affected. So one of the areas that we're paying close attention to in a lot of the holdings that we're talking about in our portfolios right now are the not necessarily the mega cap tech names like the take the Mag 7, your Microsofts, your Amazons, Googles. We're more so talking about the picks and shovels that goes into the data centers right now. Because the amount of backlog that we have to build data centers, I believe Eaton's CEO, I'd have to fact check this just to make sure. But on the conference call, he brought up about an 11-year backlog for data centers.
Wow.
With how long they take, with all of the product that they need. So that's a pretty big deal. So that gives you earnings visibility into a lot of these companies, which you typically don't have. So when you're investing, a lot of times you look out over the next year, maybe, and then you get estimates from Wall Street analysts that have 2, 3, 4, 5-year estimates. And it's like, you might as well just be throwing a dart at a dartboard at that point.
Right.
Because you don't know really what's going to be happening in 5 years. But
true.
One area of the market that you typically do is utilities. Regulated utilities, they tend to give you what their earnings are going to be, that they're regulated so that you know how much their earnings can grow by. And every 3, 4, and 5 years, depending on the county and the government, they have to redo their caps. So you kind of have an idea over the next 3 to 5 years what utilities are going to be earning, which is why people like utilities for the most part. Now we're starting to get that visibility into AI infrastructure on companies that typically you wouldn't have it. So, and like I said earlier, I think we're in that first few innings of this AI. I know it seems like we've been talking about it for the last, 2.5, 3 years, ever since ChatGPT came out. And it's all anybody ever talks about. But I truly think that we are in this first few innings, and there's a long runway. And it's more so.
Oh, it's in its infant stages still.
Picks and shovels is kind of where we're going, which is why we think our view is that we'll have a broadening out of the market, and you're going to start to see companies that are more value oriented. So there's value in growth stocks. Value is your bigger, more tenured companies. They pay dividends. Your growth are your Metas, Googles that have you typically have seen a lot of growth. So we think there's gonna be a broadening out into more of those value type of names, your industrials, your financials, rather than just technology leading the pack.
I think that's really amazing. Obviously, you need to watch things like that, and companies who are involved in, like you said, I think you mentioned Eaton with data center building and that behind that, because data centers are huge. They're everywhere. My dad has some farmland in southwestern Minnesota, and there's a huge debate going on. They want to turn about 1,100 acres into a data center. So. Yeah, I mean, and the amount they're offering the farmers for the land is amazing, right? It's more money, but the problem is that most people are fighting it because the one thing you can never make more of is farmland. You can't do it. You can't do it. That my grandpa always told me. He owned a few hundred acres in farmland and a big farm, and he said, the one thing they can't make more of is farmland. That's why you get a good price for farmland. So. Actually,
one interesting thing that, as we're talking about data centers, that has started to circle the internet it's an interesting concept, but building data centers on the moon.
In space or on the moon.
Because everything that we're using is satellites at this point now. And so you start to think about SpaceX, Elon Musk, he's got XAI, he's already got his, what's the internet service that he has? I always blanking.
Data link or some
No,
link?
Starlink.
Starlink. Yeah.
So he's got all of these like space services,
Yeah.
and SpaceX specifically, why it's so hot is it's really the only carrier that can launch satellites, but it may be the only one that can launch enough stuff into space to actually build a data center in space. And the closer your data center is to all the satellites and everything, the better.
Yeah.
So
yeah, they're
that's actually
talking
an
about
interesting concept.
even one that orbits or on the moon or in orbit. And the key there is the reason behind it. Elon's talking about this, and others are scientists because of the cooling, because of the energy use and the cooling. Well, it's cold in space.
A while ago,
on
they
the
started
moon.
building that stuff in little pods in the ocean.
Yeah, because of the cooling needed, the energy needed for a data center to cool it all. Well, it's ice cold up there in space.
Yeah.
So, yeah.
So thought you might like that one, Jason.
Yeah, no, that's pretty neat. And again, this is something that some of our listeners and viewers are probably like, "Oh, this is a boring show," and but others of you are like, "Wow, like this is something I wanted to hear about it." So,
Yeah.
again, I've mentioned it many times, Tony, when you and I talk, is hey, not every topic we cover is going to get everybody excited, and not everybody's going to benefit from listening to other show, other than just saying, "Hey, did you hear the Three Stooges again on the radio this morning?" and so hopefully you get some good chuckles. But I really do hope that all of my listeners and viewers, if there's just one little tidbit you could take away from something I said or Tony said or that Tyler is able to share with us, that's what it's all about, right? If we can benefit you in one way to maybe, hey, I'm going to take advantage of this AI infrastructure, this picks and shovel stuff that Tyler's talking about, or wow, I'm going to stay away from this certain sector or region or product or company because it didn't sound like that really sounded like the place to be right now. That's awesome, right? We are here to help, in any way we possibly can. And obviously we're not giving direct investment advice on the show today either. We never do. We never give direct investment advice, but if there are any questions that you have as a listener or viewer, any topics you want to hear about, maybe it's gold, maybe it's real estate, maybe it's oil, maybe it is more about AI. If there's any topics you want to hear more about, any questions you have, please call my office. Just let us know. We'd be happy to do a show based on what people want to learn about. I'm always looking for topics. I'm always looking for ideas of what can we talk about today. And again, I don't necessarily just want it to be what I want to talk about. I want it to be what my listeners and viewers want to hear, what they want to talk about, what they want to learn more about. Please call the office and let me know. We'd love to do some shows and answer some questions that'll directly impact you.
Awesome. Well, it's been a great show so far. We're taking one more quick break. We're going to give away 10 more copies of Jason's book, Empower Your Retirement. So the next 10 people to contact the office and request a copy, they'll send it out at no charge, no obligation, no postage. Empower Your Retirement, written by Jason himself. Call 989-835-7203. That's 989-835-7203. All right, and you're listening to your Financial Empower Hour. Jason, we have Tyler Ellegard here. What else do we want Tyler to talk about? I know that the answer to everything we've been talking about is probably working with you, Jason, and you're in contact with Tyler. These accounts are actively managed, and that's what our listeners out there want, right?
Well, it's not necessarily what they all want, Tony. I mean, it's what we need. It's what we need, right? I'm a financial advisor, fiduciary advisor. Tyler is a portfolio money manager. So these are things that we think make the best successful plans in retirement. Is number one, have a written plan. Have a formal written plan that's written down on paper. If it's not written down, how do you remember it? How do you assess it? How do you validate it? How do you rebalance it? How do you reallocate? How do you make change? Have a written plan, right? That's number one. Number two is we truly think that it is going to be in your best interest and help you out more through the long run, through the ups and downs, if you work with a fiduciary advisor and you have active portfolio management. So there's a lot of variables there. Number one, have a plan. Number two, review and update the plan. Number three, have somebody on your team there to help you, like myself, and then have somebody that's in the trenches managing the money. Pretty hard to have the person that writ the plan, that looks over the plan, that rebalances the plan. They're also in the trenches managing the plan, doing the buy-sell trades, doing the reach. That's a lot. That's a lot, right? So having a team there, like I'm not in the trenches. I don't do the research, the buy, sells, trades. I entrust in third-party wealth managers that's all they do. And they're very good at it. And Gradient Investments happens to be that team. So yeah, we think it is important to have a plan, have a fiduciary advisor to help you build the plan. They're going to help review it. They're going to help monitor it. They're going to help make changes. And then you have a team like Tyler and Gradient Investments in the trenches, physically managing that plan for you. Two different ways that I think we should talk about managing money. And Tyler, I want you to kind of chime in on this. Okay. There's two different ways people manage money. Number one is passive management. And number two is active. And as a fiduciary advisor, I love them both. I think they both have their pros and they both probably have their cons as well. Some people should have a little more of one or the other. But Tyler, can you give us a good definition of what is active management? What is passive management? And then how are they each different depending on what the market's doing? And how does Gradient utilize active versus passive management?
Yeah, so I would say active management it's more watching the portfolios and watching what your money is invested in and actively making decisions on a daily basis, weekly basis, monthly basis of what you should be owning in your portfolio. Whereas passive, I mean, and look, active management, you can argue for it, you can argue against it. My job is to try to add value over the course of time. Maybe over a course of 3 months, yeah, I might underperform my benchmarks, but hopefully if I do my job correctly, over a 3-5 year period, the opportunities that I'm finding in the market, owning what I think are the good companies and not owning the bad companies, right? Because not even to not buy something is an active decision.
Absolutely.
Yeah. Yeah.
So my job is to add that value over the course of time and give you a better return, but also try and smooth out that return.
Yeah.
Right? You can go up and down with the market, and that's totally fine. But hopefully when we're going up, I go up just as much, if not more. But then also more importantly, I think for a lot of clients is protect you a little bit more on the downside. Obviously my mandates are specific mandates, so I have to stick to that. I can't just go 100% cash and not own 50 stocks in my portfolio because that's what I've told you I'm going to give you. But my job is to find the companies that may weather the downside better.
Yeah.
Right. So instead of being down 10%, hopefully we're down 8 or 9. Right. And still staying within the box the guidelines that I've been given. So that's the idea of active management, is that you smooth out those returns and hopefully add more value over the course of time. Whereas passive, you can just own the index and that's what you get.
Yeah.
And no decisions need to be made. And each way is fine. I personally think active is better, but I might be biased.
Well, and I've reviewed a lot of different portfolios and investments. Probably, if I think about 24 years ago when I became an advisor, one of the things that we do is we offer a portfolio stress test and second opinion. And what it is it's really like an MRI or an X-ray of people's current investments. What's going on inside your 401k? What's going on inside your mutual funds, your REITs, your ETFs? What's going on inside your IRAs, your Roths, all those different types of things. And it truly is like a financial MRI or a financial X-ray. It just shows you what's going on. It shows you, where are the good areas and things you don't need to work on. But more importantly, where are the potential problem areas, right? Something that might be fractured. It might be broken. You might need to do surgery. You might need to just put a splint on it, so to speak. And when we identify, most of the times through the last 24 years, when I've literally done thousands and thousands of portfolio stress tests and second opinions on different portfolios, most of the time where we find the breaks, where we find the problems, or the best places we found opportunities to make improvements and corrections, it's been with passive managed types of vehicles. It's been with passive advisors or passive accounts or passive management. And so I would agree with you, Tyler, that when you said you believe that active management long-term is probably a better place to be, I've seen it firsthand. I have seen it firsthand from the portfolios that we've reviewed, literally thousands of them over the last 24 years. We've seen that's where most of the problems are, most of the opportunities are. Not all of them, And then we've watched that transition where we've helped families go from passive to active management under the supervision and the management of Tyler and his team. And we've watched the improvements, and we've watched the risk go down, meaning people don't lose as much money. We've watched the return go up, meaning they actually make a little more money. We've watched the fees sometimes actually go down. And people are like, how the heck if they're active? Sometimes when you're active, you just don't need to charge as much. It's just kind of in the nature of how it works out. We've seen their income go up. So if anyone out there's thinking, wow, I'd like to see, maybe my risk go down a little. I'd like to see my income or my returns go up a little bit. Let us know. It could be as easy as shifting from the type of management you're using, maybe shifting from the type of advisor, or just the simple tools you're using. Are we using passive management, or do we need to take advantage of active management opportunities? And I'd be happy to set up phone calls with Tyler, another member of his team, so you could talk to them one-on-one, and you can ask them, how do they think you're doing, and if they think they can help you or not. So Tyler, this has been awesome. I appreciate it again when I can have you or another member, of your team on my show. Before we wrap up, Tony, let us know how much time we have left, but I'd like to do the Tyler hot seat. I'd like to throw Tyler on the hot seat for how many ever minutes we have left, Tony. And I want Tyler to give us the 1, 2, or 3 things. Number 1, take advantage of. Number 2, look out for.
All right. Well, I'll tell you what, we're almost out of time for the radio show, but this will be a bonus on the YouTube show, on the video. You can go to YouTube and see Tyler in the hot seat. All right. Ask him the question. So, Tyler, what were the 2 things that we want Tyler to tell us?
So I want Tyler real quick, just give us maybe the number 1 thing you can think of to look for to take advantage or opportunity. And then the 1 thing to run the heck away from, the biggest problems out there to be scared of.
Biggest thing to take advantage of, AI infrastructure. There's a few companies that come to top of mind, but I don't know if you really want me to be from the compliance side. I don't think
you
want to
don't throw company names out there. Just, sector like that.
AI infrastructure, continue to watch that because it's not just the mega cap tech names that are going to be driving the ship anymore.
Okay.
One thing to watch out for. Oh gosh. I would watch out for energy companies. I do think we'll get some type of resolution. Oil comes back down to, even though it may take some time for oil to work its way through the system over the next few months, because it's about 20% of supply goes through the Strait of Hormuz, or seaborne shipments go through the Strait of Hormuz. So it's going to take some time to unwind that. But I do think as soon as oil goes from that $100 to $120 a barrel back down to that 80 to 60, which is kind of more of that normalized range, I think your energy area is not going to be feeling too hot because the stocks have done very, very well.
Yeah. Wonderful. Wonderful. Thank you again, Tyler. It's been awesome. Appreciate having you on the show.
All right. And before we go, I want to give out the phone number and contact information. Listeners and viewers, if you have a question for Jason and his team, if you want to set up a consultation to get a financial plan in place, you want to talk to Tyler, you want to get an overall financial plan or retirement income plan in place, pick up the phone. Give Jason and his team at Great Lakes a call. It's 989-835-7203. That's 989-835-7203. Or go to GreatLakesInvestmentAdvisors.com. And that does it for today's episode of your Financial Empower Hour with our host, Jason Cryderman, and special guest, Tyler Ellegard.